Hi everyone, it's Chloe from Superfund Partners here. I'm here today with Mark. He's from the Quill Investment Committee, and this is our first investment landscape chat that we're doing. So, thanks for coming, Mark.
It's okay. Hopefully it's the first of many to come.
Yeah. So, for those that don't know, Superfund Partners, we look after close to 400 self-managed super funds, and as the manager, I see lots and lots of different types of investment strategies, some all in cash, some having shares, lots of different things going on. But one of the things that I see a lot is that people make comment about the markets seem to be quite difficult for investors to know where to go and what to do.
Absolutely.
What are your thoughts on
Yeah,
that?
absolutely. Look, I talk to a lot of professional managers as well as we interview them, and they're all saying the same thing too. Very difficult markets for them. And for the average investor, we've got low interest rates to start with. We've got equities which have got reasonable dividends, but we've got high volatility and a great degree of uncertainty. And then within the equities markets, we've got materials and oil. The supply-demand outlook doesn't look too good there. We've got the banks. Maybe they're going into a bad debt cycle, and we've seen some of this happen just recently with them announcing a bit more write-off on some of their materials companies' exposures. And then on the other hand, if you want something that's defensive, those defensive stocks are what I call expensives. So the defensives are expensive.
Correct.
You pay a big price. So you get Ramsay Healthcare and the CSLs, and even ones like Wesfarmers, which with Coles and Bunnings being the big part of their business. Nice and defensive, but you're paying a high price for them. So it's very difficult to sort of know exactly where we should be going right now for a lot of self-directed investors.
So do you think there's any middle ground between equities and cash?
Well, the other asset class is obviously property. So when we talk about property, most people are thinking about residential, obviously. In residential, I think, in a lot of those markets, we're probably getting close to the top of the cycle. And particularly Sydney and Melbourne markets seem to be close to that top of the cycle. And then in some of the sub-markets, even in places like Brisbane, the apartment prices and that kind of thing, we're seeing a lot of supply come on. Sure. So it's hard to see a lot more capital gain coming through. And your net income after all of the expenses is going to be about 3%. So there's not a great deal of joy there. But then in a subset of that, well, not so much subset, but the other part of the property market that is not seen, I think, by a lot of investors is that retail, commercial and industrial sector.
Sure.
And obviously a lot of those properties are too big for the average investor to buy by themselves, so they're looking at buying a residential property because that's small enough bite size for their fund. But within that commercial, industrial, retail, most people would be familiar with the listed equivalents of that. So you'd have a lot of clients with some Westfield in the portfolio, which has now become Scentre Group, GPT and trusts like that. So they're very diversified. But even those with the way that interest rates have been squeezed down so far, the prices for those have increased quite a bit, and they're trading at premiums to net asset backing. So, for example, Scentre Group, trades now on about a 4.8% dividend income. So not a great amount of joy there. No. Still reasonably defensive, even if residential markets come off a bit and, the banks write off a bit more debt, probably those trusts will still keep distributing the same amount of income. Okay. But not fantastic value at the moment.
No. So do you see any opportunities in that sector at the moment?
There are a few small things that I think are still relatively undiscovered.
Sure.
And what's happening in that sector is what we call cap rate compression. So cap rate is the capitalisation rate that's applied to a property. So, for example, if you've got say $1 million property and it's earning you $68,000 of net income, we would say the cap rate is 6.8%.
Sure.
Okay. A lot of those listed property trusts are now trading on cap rates implied that are down closer to the 5s. So what would happen then is if you applied that same 5% capitalisation rate to that $68,000 of income, suddenly instead of that property being worth $1 million, it's now worth about 1.23. So about a 23% capital gain just for that change in that cap rate from 6.8 down to say 5.5 or something like that.
Okay.
So there's still some trusts out there, unlisted trusts, that have these assets in them, which I think will gradually be revalued.
Yeah.
So the Charter Hall, there's a couple of Charter Hall ones that are
Okay.
examples of that.
Okay. And what are the Charter Hall ones at the moment? They usually have the direct office
Yeah,
offering.
that's right. Yeah,
So-
a lot of your clients may already have,
Yeah.
or some of your clients may already have that in there.
Yeah.
So that trust is about to be closed fairly
Okay.
soon. Probably
Sure.
by the end of this month, actually, that'll close off.
Okay.
So there's still an opportunity to get into
So
it.
the average investor can go directly to Charter Hall, or is that through an advisor?
They can go
or-
to Charter Hall,
Okay.
they can go through their advisor.
Yeah.
Probably best to go through their advisor. You'll get data
Sure.
feeds and the advisor's kept up to date, so they
Yeah.
can talk to us if they'd like to. So that Charter Hall office fund, currently if you're buying in, 6.6% income
Nice.
paid on that, so it's getting you up there.
Yeah.
Is it stable? Well, the average lease expiry in that trust is about 9.5 years at the moment.
Okay.
So that's a lot longer than the average in the office sector. Average office sector for those sort of trusts is around 4.5 to 5 years.
Yeah.
So you've got long lease expiries, you've got a good income, and it's from pretty much a AAA set of tenants.
So from a stability rating, it's looking quite
that's
okay.
right. Yeah, and there's a plan for that trust to be fully liquid in 3.5 years' time.
Okay.
So investors need to be committed for 3.5 years
Yeah.
if they go in today,
Mhm.
but there will be an opportunity in 3.5 years for all investors to redeem.
Okay.
And thinking ahead, there's still going to be, 5 or 6 years to run on the leases on all those properties. So I think that, the values will continue to increase to reflect that.
Right. Any opportunities sort of in the industrial space as well?
Yeah, Charter Hall also have an industrial fund. They've had 3 actually. They've closed the first 2.
Okay.
They're on their 3rd fund at the moment. Charter Hall Direct Industrial Fund, and that one has about a 7.1% yield at the moment when you buy into that. It has 6 properties in there, and typical properties are a Coles distribution centre type building,
Okay.
very large, obviously, quite a dedicated purpose.
Yeah.
But the upside is 15-year leases to, a blue chip tenant like Coles. Not only that, but 2.75% CPI or
Right, so you've got those
2.75%
increases.
indexation
Yeah.
each year. So you're getting 7.1% now, but it'll be a bit more next year and a bit
Mhm.
more the year after that. And again, that one will have a liquidity window in about 6.5, 7 years.
Mhm.
So we'll still have a long time to run on those leases to blue chip tenants. So you've got to think about, it's not only when you buy a property, but when you sell a property.
True.
In the market, you know what they say.
Mhm.
They often say it's when you sell the property that you make the money.
Yep.
So you need to think about who's going to be the buyer when I'm looking to sell this property. If you've got a
Absolutely.
property that's still got 5, 6 years to run on a lease to a good tenant, it's going to be a much more attractive property when you're looking to exit.
Mm. So overall, what would be your takeaway message about what's happening in the market at the moment and what people should be looking at?
Yeah, a lot of the fear factor is already priced into a lot of the stocks that are out there. So
Mhm.
don't be too fearful. Interest rates are going to stay lower for longer.
Mm.
Don't be waiting for term deposit rates to be back at 5 or 6%. That
It's
is
not
not
gonna
going to
happen.
happen anytime soon.
No.
But as I said, in that middle ground, you've got some of these things with a nice stable income, bit of a trade-off in not so much liquidity,
Mhm.
but good stable income, good tenants. It's an ideal thing to have as part of a self-managed super fund portfolio.
Yeah.
And I think interest rates lower for longer. The central banks are out there making sure that the economy is not going to fall over.
Mhm.
But by the same token, the credit boom brought forward a lot of that future consumption into the last decade.
Mm.
And now we're just sort of paying off the debt, and that's why growth is going to continue to be fairly slow for another 3 or 4 years yet, I would say.
Okay. Well, there are some options on the table for people, obviously, and there are some good things out there. So thank you, Mark, for coming in and
No problem.
having an investment chat with us. If anyone wants any more information or would like to be connected with an advisor or some general information about anything to do with investments, please give me a call. I'm happy to point you in the right direction. Thanks.